Hey there, everyone, and welcome to this edition of The Final Bar. It's Thursday, December 14th, 2023. Welcome to today's show. I'm Dave Keller, Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. When I talk to clients, consumers, investors, traders about how to make sense of the markets, I always tell them it's all about your situational awareness. It's all about your awareness of what's happening around you as an investor. And I've spent a lot of years experimenting with a lot of different disciplines. I will tell you, I've yet to find a better one than charting and technical analysis to really inform you about what's happening. So many times we get our blinders on, we focus on particular markets, particular trades. We forget about the landscape, right? The overall forest for the trees, as it were. And I hope through the Final Bar, we're able to show you how technical analysis and the Stock Charts platform indeed can be used to help you make better decisions based on having better information available to you. Today, we're going to talk about this sort of digestion day that we're observing with the S&P 500 and the NASDAQ. No big change from yesterday, but depending on what part of the market you're looking at, it was actually a banger of an up day. Energy stocks up 3%, small caps, the S&P 600 up another 3%. Insurance companies getting dinged big time to the downside. We'll look at as many charts as we can here. And we also have a great guest live in our studio, Julius de Kempenaer, founder of RRG Research. We'll talk rotations here in a little bit. Before we do that, let's get to our market recap and talk about what happened today in the financial markets. Before we do that, quick comments about a poll. We asked you recently what percentage of your portfolio is in non-U.S. stocks. And this is a question I would encourage you to consider, not just one moment, not just at this particular time, but in general, right? Think about that non-U.S. exposure. I think for a lot of American investors, we have, such a robust, liquid, dynamic market in the U.S. that it's tempting to not go outside the U.S. But certain times, certainly when the dollar is in a change of character, non-U.S. holdings can be a huge tailwind to your performance. So over 50%, only 14% of you said that. Let's say, any non-U.S. holdings, just over 50, we'll say about 58%. I answered with some value. 0%, 42% of you said absolutely no holdings in non-U.S. stocks. Now, I would argue, again, you need to do your due diligence, make the right decision for you and your portfolio, and consult with a financial professional. But if you have 0% in non-U.S. stocks, I would certainly think of that. When you look to 2024, what could happen? Think about those potential risk scenarios of what could happen if the dollar strengthens dramatically or weakens dramatically based on what we've seen in 2023. That non-U.S. portion of your portfolio could be a very important way to diversify what you're doing in the equity space. So good question to consider, and there's no necessarily a right answer, but getting you thinking is really the goal with that one. Let's keep going with our market recap. As I mentioned, I would describe today as a digestion day. Yesterday, of course, we had the big meal. Yesterday was the Thanksgiving meal of the full table with all this stuff, right? After the Fed meeting at 2 p.m., the Powell press conference at 2:30, the markets were pushing aggressively to the upside. It ended up being a pretty solid up day after treading water in the morning. Today, gapping higher at the open, but really sort of chopping around for the major averages. The S&P still above 4,700. That's a nice push, well above the previous swing high around 4,600. We're now continuing to the upside, up about 0.25% today. The NASDAQ composite up about 0.2%. Worth noting the S&P 100, that's the mega cap, largest names here in the U.S., flat. This is an inch from yesterday's close. The NASDAQ 100, dominated by mega cap growth stocks, down 0.2%. Small caps, the S&P 600, up almost 3%. So that shows you the differentiation today between small caps, mid caps having an incredibly positive day versus the largest company struggling a bit today. Again, today's guest, Julius de Kempenaer, we're going to talk a little bit about that size versus style versus sector relationship and where some opportunities may be going forward. The VIX pushing a little bit higher as well. So as stocks have rallied yesterday and today, volatility is actually increasing. It certainly feels like a volatile period here. A lot of choppiness as we continue to digest that meal that we had yesterday. One of the big changes that we observed yesterday after the Powell press conference is a rally in bonds, right, and sort of a drop in yields. The 10-year yield, of course, has come from 5% not too long ago, right, a month ago. We're talking about the 10-year yield in previous months well up to that 5% level. Now we're down below 4%. The 10-year yield currently around 393. The long bond yield still just narrowly holding that 4% level at a 4.05, and the 5-year yield, of course, below 4% as well. So what we've had is the longer end of the curve coming down quite a bit. Bonds are rallying, and part of that rotation has been defensive areas of the market, sort of higher yielding sectors in the market, doing much, much better. And you'll see today real estate, one of the top performing sectors. Bond prices, of course, as yields are coming down, that means prices are going higher. So the TLT, which is a Treasury bond ETF, was up 2.6%. The dollar down about 1% from yesterday. That's one of the reasons why we wanted to ask you about non-U.S. holdings. Big weaker dollar means you may want to consider sort of that non-U.S. component where there could be opportunities outside the U.S. Gold, silver, crude oil, copper, all the commodities that we track in our top 8 commodity ETFs in the green today. Silver prices up 1.8%, gold up 0.6%, crude oil prices pushing higher in a pretty big way. Also natural gas in the energy sector, as you'll see in a moment, the top performing sector out of the 11. Looking at cryptocurrencies, Bitcoin just below that 43,000 level. It was above that earlier, kind of settled down. So at the end of the day, kind of in line with where we were yesterday. Ether prices just below 2,300, moving a little bit stronger than Bitcoin. And overall, cryptocurrencies, of course, had a big drawdown here recently, now popping up a little bit off of the low 40K level that we saw yesterday. Looking at the 11 S&P sectors, energy soundly at the top of the list, followed by real estate number 2. Energy up 3% today. Real estate up 2.8%. Materials was number 3. Now, these are 3 sectors that I would say, having done this show every day in 2023, most trading days, I don't know if we've seen those 3 sectors at the top any day this year. It tells you what a different environment we're now starting to observe here. This has been a very growth-dominated market in 2023. Here in the last 6 to 8 weeks, we're starting to see quite a rotation. That aggressive move off of the October low, that strong November now followed by a strong December, sort of injected with further optimism yesterday, starting to be not just about mega cap growth, but all the other things. As a matter of fact, as we'll see in a minute, mega cap stocks, particularly in the growth space, not doing particularly well this week. Consumer staples giving back some of their recent gains, down 1.5%. Utilities, second from the bottom, down 1.3%. Healthcare shed about 0.5% from yesterday's close. Let's go to a daily chart of the S&P 500. Here's today's candle right here, or a bar, and you probably call this a doji candle. It's very, very close. And a doji candle is anytime the open and close are right around the same level. So it sort of looks like a cross on the charts. You have the vertical line representing the high to low range. The open and close are kind of right around the same level, and you can see that blown up right about there. So it's not perfect, but close enough that I think you'd call that a doji candle. Now, for what it's worth, a doji candle in Japanese candlesticks represents indecision. Basically tells you there's been a big run higher. Now we've stalled out, and after most days in the last 6 weeks have been up days, many of them certainly have pushed higher, and this little brief pause at the end of last month, beginning of December, a bit of an aberration. Other than that, a lot of strength, certainly in the last week and a half, a lot of higher highs through the course of the trading day. Today, all of a sudden, looks a little bit different, and that often can be a short-term reversal signal telling you the rally is now stalled out a little bit because additional buyers are not coming in today and pushing prices higher, higher and higher. Now, worth noting that in certain parts of the market, particularly small caps, it was another big up day today. The relative strength index, the RSI on the S&P 500, is very close to 80, which is what I would label as extremely overbought. You'll find a number of stocks are actually pushing up into that region. Home builders, if we have time to get to it here in a moment, I'll show you some examples of names that have gotten up to that point. I just want to briefly highlight small caps. We had a great conversation yesterday with T.G. Watkins here in the studio talking about different parts of the market. We talked a little bit about small caps. And, you know, what's interesting is on the daily chart of small caps, really impressive run, right? Off of the October low to now where we're at in mid-December. And I mean, an incredible retracement and really retracing 100% of the drop from late summer, early fall. But what's interesting is this whole rally is basically getting us right back to the highest point that we've been over the last 18 months, which you have to remember is on the weekly chart. Small caps have been just range bound for quite some time. Now, at some point, that basing pattern is broken, and what you look for is a push above the upper end of that base. Arguably, we're seeing that happen here at the end of December, and I think that's something certainly to watch. As the weekly chart, we're back above 150-week moving average. We're eclipsing the previous swing highs, making a new high for the year. All that's impressive, but again, I can't help but notice that we're overbought getting to the upper end of this range we've been in. It just makes me, my contrarian hat is glowing red, suggesting there's a pullback that happens at some point when you've had this rally. Watch that gap, by the way, on the IWM. That's a Russell 2000 ETF, something that we just observed. I want to show you some of the larger names just to tell you, sort of hint at what I'm getting at here. Amazon actually down today by 1%. And if we look at the candle chart of Amazon, not particularly good. I think you'd label this a bearish engulfing pattern. It's not the most perfect one I've ever seen, but similar to what we saw here in mid-November. It doesn't necessarily mean we go and go down to zero or anything, but usually suggests that the rally that leads up to that pattern is at the very least pausing for a bit. And that's what we ended up having here in November. Right? We kind of stalled out, really ended up being sideways for quite some time. We've reinitiated this upswing, but again, you have this distributive pattern of an up day followed by a down day. The second day's body of open to close engulfs the first day's body. And again, that sort of basic candlestick pattern tells you next couple days probably weaker rather than stronger. What Steve Nissen years ago taught me about a two-bar pattern like this is you look at the high of the pattern, and that's your natural built-in stop. So if we would eclipse today's high in the next couple days, that would tell you, nope, it wasn't the right pattern. We've been stopped out and gone higher. But Amazon looks like that. Microsoft, of course, that's not the ticker. Microsoft, here we go. Down 2.25% today. So on this digestion day after yesterday's rally, at a time when small caps are up 3%, Microsoft almost matching that percentage decline in terms of the same absolute value, but going lower. Microsoft's actually at the lowest of the last 3 weeks, continuing to pull back after making a new swing high. Netflix, kind of a similar pattern. So these are the patterns you're seeing with some of these mega cap names. Now, are they horrible charts? Of course not. Are they medium term, long term still strong? Of course, because they're making higher highs and higher lows. But rotations lower often start like this, where you retest a key resistance level. In the case of Netflix, it's around 475, 480. You stall out there. You have this big distributive pattern like we saw today, suggests short-term weakness in some of those mega cap names. Now, everything I just said is not the way I would describe a chart like home builders, right? The ITB up another 6% today as rates have come down. The 10-year yield now below 4% in a pretty big way in the last couple of days, really magnifying that decline. That is making buying a home a lot less expensive than it was just a couple of weeks ago, right? That rotation that we're seeing lower in rates gives room for home builders and Home Depot and things that you would use to buy things around your house, just making them less expensive and certainly making the companies seem like a more significant opportunity going forward. If rates are going to come down like this, it gives opportunity for these areas of the market to do quite well. Now, with a lot of home builders like Lennar and Toll Brothers, with home improvement retailers like Home Depot and Lowe's, the challenge is we've had such a run, and my concern with something like this, we might be seeing an exhaustion gap. And if you know gaps, there are different type of gaps that happen different parts, different times during a natural cycle. When a move has already played out quite a bit and you have one more gasp higher, a lot of times that can be an exhaustion gap. Now, what you need to look for is tomorrow, beginning of next week, do we fill that gap? Do we hold that gap as support? Do we see any signs of people selling into this big sudden jump higher on some of these key names? These stocks are incredibly overbought right now with the RSI above 80, getting near 90 for some of these stocks, something to watch. Enphase Energy, kind of a random one to throw up just to finish off our market recap here. We'll go to a candle chart again. I just want to show you how some of these names have had, I'm observing a lot of candle patterns. A doji candle on the S&P, we mentioned a bearish engulfing pattern earlier on growth names. Now we're looking at Enphase Energy. This is a stock in the renewable energy equipment group with solar stocks and hydrogen names and things like that. Had gotten above its 50-day moving average at the beginning of December, pulled back right to the 50-day, and yesterday we sort of sitting on the 50-day, the previous day, sitting right on that 50-day moving average. Today, we open lower, but we close much higher. So that is a bull. I'm sorry, this was yesterday's candle here. So a bullish engulfing pattern, and what that suggests is this little downswing is probably over because people are buying in on that weakness, buying into potential support at the 50-day. Sure enough, today, gapping higher. That's kind of what you would often expect after one of those bullish engulfing patterns. So we saw one of those pop up yesterday. I would keep an eye out for these. In our scanning engine, actually the predefined alerts on stock charts have some of these candle patterns already built in. You can go through, if you click on charts and tools, you'll find some of those listed out. But great way to identify some potential short-term reversals. We're going to look a little bit more at financials here, time permitting, as we continue on with the show. But I just want to highlight some of the regional banks. Zions Bank is one we're looking at today, up almost 10% today, right? Up over 9% today. And this is breaking out of a pretty significant resistance level. The financial sector, again, one of the big, arguably big surprises in November, right? I mean, really starting to improve in a way that we've not seen in quite some time. And what's happening is some of these stocks gapping higher today, but really that's just continuing this nice rotation, right? From a downtrend, a pullback phase into the October low to a pattern of higher highs and higher lows, now gapping higher today. And, arguably further upside to be had as we continue to push out of these basing patterns. And on the weekly charts, you'll see what a big breakout some of these actually are. Now, there's another side of financials, which are the insurance companies. And these have been some of the strongest names that we've observed. We've highlighted charts like Assurant, which we'll look at here maybe in a minute. This is Gallagher, AJG. And you can see just this incredibly orderly uptrend. Today, down over 7% today. We saw a bearish momentum divergence in November. Higher highs here, lower peaks in momentum, and now that is sort of continuing with a push lower. Now you look to the left and observe the fact that we're at the October lows. We're right above the 200-day moving average, which has served as support previously. So I'm wondering if that was just a big sudden move back down to support. But that would be the question tomorrow and into next week. Do you see buyers coming in and buying on weakness? These are really long-term strong charts, just really until this week. Marsh and McLennon, MMC, also getting that bearish divergence here in November and December with higher highs in price, lower peaks in momentum. This is why we like to highlight those when we see them. And you can see today, of course, down over 5%, breaking below the 50-day moving average. I mentioned Assurant, AIZ, down about 3%, probably not as dire as some of those other charts. But again, you can see this familiar pattern of bearish divergences today sort of, initiating that pullback off of those previous highs. So a lot of these charts, again, still holding above key support levels, but certainly something's changed today. And I think that is why looking for stocks that have had big moves, I often scan for stocks making new 3-month highs and lows. I love to, on my dashboard, focus on names that appear in the market movers widget, big gainers and big losers on the given day, and just make sure that I'm aware of some of those movements that we've observed. That's where a lot of opportunities can pop up for you. That's it for our market recap. We're going to take a quick commercial break, and we're going to be back with today's guest, Julius de Kempenaer, live here in our Redmond studio. We'll see you back here in a minute.
Every year, investors lose millions because they're buying and selling stocks based on headlines, a friend's latest prediction, or social media hype. StockCharts.com offers you a better way so you can relax while you stay on top of your investments. StockCharts.com is the world's leading charting and financial analysis platform. Our exclusive technical alerts system allows you to set up your alerts in advance and actively monitors thousands of indicators against every stock symbol and index, so you'll be the first to know when a stock is moving up or down. Build your system and set alerts to buy or sell based on the indicators you care about, not the latest headlines or financial gossip from a self-proclaimed expert. Trade with confidence, because at StockCharts.com, better insights lead to better investing. Start your free trial at StockCharts.com.
Hey everyone, welcome back to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. Great to have you join us every weekday after the close for our show. A couple quick announcements before we continue on with today's guest, Julius de Kempenaer. First off, we love hearing from you. We're going to do a mailbag special episode next week, and we'd love to feature one of your questions on the air. You can email us your questions at thefinalbar@stockcharts.com. We are on the Twitters at FinalBarSCTV, and on our YouTube channel, of course, just drop a comment below the video that you're watching. We love to hear feedback on our show as we start thinking of planning going forward in 2024 and beyond. We'd love to think about some of the feedback that you guys are sharing. So please take a moment, let us know what you think, what we could do better, how we can make this help you understand the markets a little bit better, but especially send us your questions. Over the holidays, anything that comes up, send it to us then, and we'll hit the mailbag more in the new year. Also, as a reminder, the Stock Traders Almanac for 2024, big thumbs up. Highly recommend Jeff Hirsch and his team do a fantastic job every year of laying out the seasonal playbook. Jeff was on this show, a couple weeks ago. We talked a lot about the current year, the pre-election year in 2023, how things match those seasonal tendencies so brilliantly. 2024 is an election year. We talked about some different scenarios based on how the election process may play out. You don't want to miss the Stock Traders Almanac for 2024. Go to our Stock Charts store. So go to our website, stockcharts.com, click on store in the upper right. Use the code Almanac30 when you check out for 30% off the Stock Traders Almanac. I would pick it up today. Fantastic gift for the holidays for investor friends and family, of course. I want to welcome on today's guest, Julius de Kempenaer. Julius is a longtime friend to Stock Charts, now a senior technical analyst at Stock Charts, also founder of RRG Research. We often talk to Julius remotely from Amsterdam. Today, we are very thankful to have him live in the studio. Welcome back, Julius. Good to see you.
Thanks, Dave. It's been a while, but
it has been. It's been too long, but I hope we'll continue to make this a frequent, a regular occurrence for sure.
Absolutely.
As we're thinking of these markets, just to kick things off, we're going to look at some of the RRGs, just talking about rotation. But we've had such an incredible move. You've been here in the U.S. during Fed Week when we saw a big move to the upside. What's surprising you? Where is your head at as you sort of look at the market conditions today? How would you describe it based on your work?
Yeah, so the first thing that caught my eye when you were doing your market recap and you were talking about the sector summary, you're focusing on the top line, like energy and stuff, and we've never seen those. And then my eyes were glued on the bottom three.
Yeah, right.
Because that was staples, healthcare, utilities.
That's right.
And those are the three defensive sectors. And I always keep an eye on them because when money is rotating out of these three sectors, that means that investors are kind of, saying goodbye to their defensive positions and they're moving somewhere else.
Yep.
And especially because they could move their money out of the stock market. But if that were the case, then the S&P should have been down or whatever major market index. But that's not the case. The market's higher. So the fact that they're moving away from defensive sectors while the market's going higher, to me, that means that that money is going to more cyclical and economically sensitive sectors. So I think that is one very important observation from a rotational point of view, if you ask me.
Yeah.
The second thing that caught my eye was one thing that I often look at is the growth value rotation.
Sure.
And that's the chart that you've got on the screen right now. So this is the weekly RRG. It basically shows you two indexes, so the growth and the value index. And they are kind of by default moving in opposite directions. But what you see right here is a very quirky kind of big swing in opposite direction because it looks as if they're pointing, but if you zoom in, you will see that the last observation is actually going almost straight opposite to that thing. If you bring that to a daily RRG, then you will see that that actually is more in favor of value than to growth. So there you see it, which again is kind of, I don't know, counterintuitive with the markets going up, being very, very strong. Some sectors being aggressively higher. Normally you would combine that thought with growth going higher, and that's not happening here.
Right.
So that got me thinking, like, okay, so there is something else going on. If we go to there in the drop down of the RRG chart page, there is another group which is called size, and that lists the three size indices, and that kind of immediately confirms what you were talking about in your market recap, that money is moving out of large caps. So that is the S&P 500. Right. And if you look on the left-hand side where you've got the small cap tail in red and lagging, and you've got the mid cap in blue and improving, they're moving right higher. They're still on the left-hand side, but look at the length of those tails. That includes momentum, or that suggests momentum. And they're moving into that nicely top right-hand northeastern direction that we like so much. So this is a very clear example of money moving out of large caps into small and mid caps, and that's like the 3% up, and I think it was 2.5 for the mid cap. So it's totally underscoring that rotation. And by the looks of it, this is going to take a little while because this is a weekly RRG. This is not something that's going to change overnight. I mean, things can happen, but normally this is the start of a bigger move that we see here.
So this is a broader move away from large caps here in the right side to small caps and mid caps, right?
Yes,
I get
absolutely.
it. Yep.
So, and by the way, the benchmark for this chart is the Dow Jones US, which is the entire US stock market.
Yeah.
So this is kind of counterintuitive. Growth, value not going there, and money moving to small and mid caps. And there is a third RRG with this theme, and that brings up growth, value, size.
Okay.
And what that does, it actually takes the growth and value themes and breaks them down in small, mid cap, and large. And now you see something which is rare, I'd say, especially if you look at these three tails in the red lagging quadrant that are moving up. You will see small caps, and you will see small caps growth and small caps value.
Right.
Moving
All
in the
clustered
same
together,
direction.
Yeah.
Whereas we would normally argue that growth and value would be in the opposite directions.
Yeah.
It's not the case here. It's going in the same direction.
Yeah.
Same for the mid-cap segment. These are the three blue tails that you see in the improving quadrant. It's mid-cap, and it's mid-cap growth and mid-cap value, moving the same direction. And then if you look at the right-hand side where you see large cap, they're moving in an opposite direction as well. So the way I translated this is that this is not so much a growth value rotation.
Yeah.
It is much more, or it is a size rotation. It's money moving out of large caps into small caps and into mid caps, regardless of growth or value. I think that's the bottom line of this story here.
So do you think, I mean, what we're describing here, do you think, does that mean the dominance of the Magnificent Seven sort of mega cap growth thing are we done with that? At least for now, is that kind of what
at least for now, yeah. It looks definitely that there is weakness in that.
Yeah.
And, Magnificent Seven, most likely, I mean, I think you showed Microsoft being down severely, Amazon was down, so
Netflix,
all of that. But that's not really impacting the market. And if you know how markets work in terms of market capitalization, the fact that when these mega caps are down severely, like over 2-3% sometimes, and the general market, the benchmark that we compare them against, is still up, that means that by default, a lot of stocks.
Everything else is really starting.
Yeah, because they need to be in balance.
Yep.
So yeah, I think that's definitely what the markets are telling us right now. That Mag 7 large caps. I don't think it means that they'll come crashing down.
Yeah.
But there is. I like the way you said it, like a digesting period. Maybe I don't think it's going to be a day. It's going to take a little longer.
It's a phase,
markets are digesting all these massive gains. And they're now starting to look to other opportunities, and it looks as if they're finding them in small and mid-cap stocks.
So as you know, I've used the RRG for a long time, and I remember when we first talked about it years ago, what I love about it really is a zero-sum game, right? Because it's based on relative strength. Assuming that you have an inclusive group of things with a benchmark in the middle.
I call that a closed RRG.
Closed RRG, and that means that based on the distances and the errors, everything kind of nets out to zero. So it really helps you think about not just if the Magnificent Seven are going to struggle, but it's all relative, right? Are things starting to change on a relative basis?
Yeah.
One of the groups that I hinted at was regional banks, right? Zion was an example. A lot of these are up a lot. You mentioned we might want to dig into the financial sector. Can we look at that and just talk about what you're seeing there? So here I'm going to go down to XLF members, right?
Yep, XLF members. That'll bring up all the members in the financials sector ETF.
Yeah.
And obviously, the financial sector has got quite a few groups. So as you rightfully showed, a few banks that are doing really well and insurance companies that are doing not so well.
Yeah.
And the way I do it is I click on the industry column on the top, and there you can group them by industry. And then just by eyeballing it, just look at that banks. They're all green or blue, and there's one in yellow. And the cool thing is if you highlight one, so you click on one, and then you can sort of, with your arrow or with your mouse, tap down, and then you can see that all these banks are going into that northeastern direction, picking up a lot of strength, picking up a lot of relative strength. If you do the same for the insurance companies, you'll see them moving the other way. So this helps you to actually, within the financial sector, find the groups that are outperforming the benchmark. So as a group, they're outperforming the S&P 500. But within the financial sector, I think you should be looking at banks, you should be looking at investor services and asset managers. That's the three groups that are doing really, really well. So take your pick in whatever the individual stock is. And I always argue people to, finally look at the price chart, because this is an RRG. It's a high-level overview. It'll give you great information about where everything is relative to each other. But in the end of the day, you can't trade an RRG. You got to trade price. It's the same with indicators. You can't trade the RSI. You can't trade the MACD. You need to trade price. So always the last step in your process should be checking that price chart. So
I love it. We only have about a minute left, Julius. I know you, I believe, are going to be part of our 2024 market outlook coming out very soon. Can you give us just a taste, a preview when you are looking forward after this year, which I feel like we all have scars from weathering 2023. When you look forward, what sort of themes are sort of bubbling around in your head as you try to make sense of the first quarter and beyond?
Well, I mean, I always find it funny, because when you and I talk off camera, we say, like, what's the use of that? I mean, looking out for a year. For a year.
Forget that part. Okay.
I mean, it's like,
it is hard.
And still we do it all the time because we like it, and people like it.
And it's tough to look forward 12 months.
Yeah,
100%.
I get it. Going into the first quarter, I think what we just discussed is probably the theme. Like large caps having kind of done their job.
Yeah.
I'm very interested to see how it goes with the small and the mid caps, because I feel that the market is getting a much broader participation. Yeah. Which makes it a lot less risky, But until now, it was the Magnificent Seven or the large caps, which is only a small part of the market. When it goes up, great for your portfolio, but when it comes crashing down, it's going to be hard. Yeah. And the risk of a smaller group rolling over is obviously way bigger than when you got the entire market lifting everything up. So I think that is probably my main topic, my main point of interest. That rotation out of large cap into small and mid cap, and whether that is continuing regardless of growth or value. Yeah. And then what I really still feel is probably the biggest risk hanging over the market is interest rates. You touched on it very briefly in the beginning. Yep. What I don't really like is the fact that you indicated that the longer end of the curve is coming down again. Yeah. And so that means that yield curve inversion that we're still in.
It's not changing.
It's not. Well, it's exaggerated. It's going. So we moved up, and before we even go back to normal, it's already getting back to. Yeah. And that's a bit of a risk, I think. So we need to always keep a very close eye on it. By the way, when I look at the asset class RRGs and the comparison between SPY and IEF, it's very clearly in favor of SPY, of stocks. Yeah, stocks over bonds. Yeah. But if you ask me to identify one risk, I'd say it's interest rates.
Yeah. This has been awesome, Julius. Good to have you live in the studio here. Thanks for making the trip over. Safe travels home. Happy holidays. We'll see you in the new year. All right?
Yeah, you too. And everybody out there.
That's Julius Kempenaer, founder of RRG Research, senior technical analyst at StockCharts, and again, live here in our studio. What a pleasure. And I love how he was describing using the RRG. Again, it's not a lot of times the answer. For me, it doesn't tell you all of the details about what triggers you may need to pull, or levers you need to pull, but it definitely tells you where you should be focused. And that's where I found it to be incredibly valuable. That's your roadmap. That's your high-level review. Focus on opportunities. Then you drill down into some of the charts, some of the timing tools, some of the ways to identify where we're at in the cycle. But again, with a focus on relative strength that I would argue always super important. Great thanks to Julius Kempenaer joining us today. We've got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I'm going a little long term with this chart here. We're looking at the movements in the S&P 500 going back to 2004. So I've got a 20-year daily chart. So a bit of a chart foul trying to push that much data into one chart. But I did it so we could do this thing at the bottom. This is the percent of stocks above their 50-day moving average. And you can see it's obviously pretty noisy when you bring in this much data, but I've highlighted in pink when it's been above 90%, and that's what I want you to focus on here. We are right about there. We're at 89, almost 90%. We actually just barely touched 90% on yesterday's close. And if you look to the left, look at the other times when we've been up in this area. If you look to the price above, and you can do it on your own, hit pause or recreate this chart in stock charts, two general takeaways I would encourage you to focus on. Number one, when we do get up to this region, more often than not, you get a pullback. Not an end of the world pullback, not we're going down to zero, not we're retesting the previous low necessarily, but we've had such a run when we've gotten to this sort of overheated breadth condition, you often have a pullback. But the second thing to note is it usually means the market's gone higher 6 to 12 months later. And that's the thing that I think is most important. Where you don't see these sorts of readings are in 2007 and 2008. In 2017 or 2018, you find this at the beginning of a much broader move. And I think that is sort of the two-pronged conclusion you can draw when things are super overbought and breadth conditions are super overheated. It usually suggests short-term pullback is imminent, but long-term strength is still very much a reality we're going to be dealing with. Chart number two, the insurance group. We talked about the financial sector, a couple different tidbits here today, and I just wanted to note candle patterns are super important to me. If I was a swing trader, I would be looking at these way more often. As a medium-term, long-term investor, I find them helpful to understand the tactical time frame, but thinking about these sorts of patterns, a bearish engulfing pattern that just occurred for the KIE, the insurance ETF, suggests short-term weakness over short-term strength over the next couple days. But we'll look at for today's high and see if we're able to eclipse that. That would negate that bearish signal. Finally, energy, the top performing sector today, having a pretty good update today after a period of significant weakness in the last couple months. I just want to highlight on the weekly chart, energy has essentially been flat for the last almost 2 years. The level that we're at right now, around $85 a share, that's the level we were at in the first quarter of 2022. So with all of the concerns about oil prices, with all the upswings and downswings, all the discussion about how underperforming energy has been, let's make a note that it's actually been sideways, really hasn't broken down, and the momentum is still holding up okay. So on the weekly chart, it actually suggests, for now, we're still in a basing pattern that may actually last quite some time. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. A special thank you to Julius de Kempenaer, our friend from Amsterdam, joining us here live in the studio. Don't forget to like this video, subscribe to our channel while we're here. It has been a pleasure doing live episodes this year. We'll be back live in the new year, but between now and year end, we have some great special programs, so don't forget to tune in every trading day. I'm Dave Keller with Stock Charts. Have a great one. Bye-bye.